Hello, Bobby Hood here. I was trying to calculate my yearly balance sheet. That's something that's required by the Farm Service Agency for me. And as part of that, I needed to know what was the remaining balance on my mortgage. And so I was doing it after hours. I don't have access to my mortgage online, so I decided to go to a website called mortgagecalculator.org. And when I did that, I was surprised greatly with what I found. So I entered my information, my interest rate, my principal, all that good stuff, and it showed me something that I wasn't expecting. So it showed me a breakdown of it showed me a breakdown of monthly payments versus biweekly payments. And I thought, biweekly payments, well, what's up with that? And so I did some research, and I wanted to break down for you how this could really help you and how I think it's going to really help me. So let's just say that you take out a 30-year mortgage today and you take it out on a house that is $150,000 and you're going to put down 20%, so you're going to finance $120,000. And let's just take a sample interest rate of 3.5%. Okay? So your monthly payment is going to be $538.85. And so over the course of this loan, you will pay $73,987 just in interest. And you won't have that house paid off until December of 2044. Now, if you were to take that same payment and break it into half, so $269.43, and you pay that every 2 weeks, over the course of the mortgage, you will pay $63,210 in interest, and you will pay off that house in February of 2041, which means you will pay it off almost 4 years sooner. How? How does that work, right? Can't be right. So here's how it works. There's 52 weeks in a year, which means if you're paying the house in biweekly payments, you are actually paying 26 one-half payments in that year. Now, if you were paying it once a month, you are paying 12 full payments or 24 one-half payments, which means you are paying an extra 2 one-half payments a year or 1 full payment a year. And this full payment goes 100% towards principal. So that's going to lower your balance, which in turn is going to lower the total amount of interest that you are going to pay over that loan. So $10,000 is what you're saving just by breaking that up and paying every 2 weeks. That's a decent car, a decent used car. Let's take this one step further. Let's say you get this 30-year loan, but you pay on it as if it's a 15-year loan. So with that, and you're still doing everything else the same. Same loan, same interest payments, but you're paying on it as if it's a 15-year loan. With that, bi-weekly, you would pay an extra $160 per payment, or a total of $428.93 every 2 weeks. By doing that, you will have your house paid off by June of 2028. That's 16 and a half years sooner. You can have a kid at the end of that, and he or she would be driving and almost ready to graduate high school in that 16 and a half years. That's a long time. You would have paid $30,554 in interest, which is $43,433 less than paying once a month on a 30-year mortgage. And by the way, you would have actually, even though you were paying as if it's a 15-year, by doing the biweekly payments, you would have only been paying for 13 and a half years. I hope that that gives you a little bit of information. I'm going to go actually onto my online banking, and I'm going to change mine to take advantage of this, because for not having a mortgage payment for 16 and a half years, that could be life-changing. So I hope this helps you, and have a good evening.